Oliver, this week started early with European regulators releasing the results of the asset quality review for European banks. Now we've had a week to digest those results. What do we think?
Well, it's not been the big clean sheet and the fresh start that some expected it to be. There were hopes that this would get all the problems out of the system. The European Central Bank and the European Banking Authority would have a very close look at Europe's banks and give them the stress test, and at the end say, right, we've decided these banks are healthy, these banks aren't and need to raise more capital, and that everyone could then have some faith that the banking system was at long last fixed. Now, the stress tests and the AQR did do that. They did find that some banks passed and some banks failed. But if you look at the reaction through the week, share prices have declined across the sector. There's not been this big increase in confidence in banks after the last weekend's results.
It's also earnings season. Did we learn anything from banks' results this week that may explain the tepid response of the markets?
Well, we learned that it's still a very hard place to be a bank in Europe. The economy isn't great, and there's the usual mixture of some banks slightly beating expectations and some banks slightly missing. But overall, it wasn't inspiring. Today, we've had numbers from BNP Paribas, a big French bank. Again, they did pretty well. The numbers slightly beat expectations, but their retail lending in France, their core sort of business, retail lending was down 1%. It's still hard to get any sort of loan growth there. And on top of that, there have been a lot more fines for misconduct. Well, not fines, but provisions for possible fines in the future. So Royal Bank of Scotland made a provision, Barclays did. So all these conduct issues are still around. We haven't got rid of those yet.
Oliver, the Lex team is a patient bunch. But how long must we wait until we can invest in banks based on prosaic things like interest margins, loan growth, and in short, the fundamentals? When will we know that it's finally time if the AQR wasn't enough to tell us?
I think you've got to wait until you see these numbers coming through in the bank's results, see them making returns on equity that are above the cost of equity, so double-digit returns on equity, which a lot of banks aren't making. They are in sort of adjusted terms, if you look at adjusted profits, but the actual profits that make money for shareholders, they're still not making great returns there. So you've got to wait and see those numbers coming through. When that happens, when there's no more provisions for conduct fines, no more capital raising, when the regulatory environment has settled down, then we'll have some clarity and we'll be able to judge banks based on their operating performances. But we're a long way from that at the moment.
So once again, a regulator waving its magic wand is not going to do the trick. Thanks, Oliver.